All right, we are going to use what we know about modified accruals and apply it to some transactions. All right, so first we'll talk about revenues, then we'll talk about expenditures. So when you're doing revenues, a lot of them come from taxes. So let's look at a tax accrual and see how that works. So remember, we've already put our budget stuff in. So you can imagine we're a city, and the city council has appropriated our funds, right? So we put that in the budget already. That's in the budget accounts. None of it's been actually done, but we're ready to do some expenditures. It's the first of the year. We're gonna take care of stuff. So the first thing that happens is for revenues from taxes, the taxing entity has to levy the taxes, which means they say, everybody who pays taxes, this is how much you owe us. You have to pay it by this date. Here's your tax bill, right? So they've levied the taxes. That's the word for it, which just means everybody has their tax bill and they have a tax due date, right? So we're recognizing the revenue. No cash has changed hands. We're not even sure we'll get all of it, all right? But we're going to put it down as revenue. We haven't done a thing. There's no exchange, right? Like normally you recognize revenue when you provide the good or service. Nope. We just said, you pay us money now. And so we've levied the taxes. So it becomes taxes receivable and revenue. So debit receivables, right? So taxes receivable, that's a asset. Receivables are assets. So increases with a debit, and revenue is revenue. Revenue always increases with a credit. So there you go, tax receivable and revenue. During the year, we'll be actually collecting it. So the actual collection, when you actually collect it, it goes to cash and taxes receivable, right? So we increase the asset cash with a debit. We decrease the asset taxes receivable with a credit. And so that's when it comes in. Now, not all of it comes in when it's supposed to or when we expect it. And under modified accrual accounting, remember, it's when measurable, so we certainly measured it. We said this is how much they're going to pay us. So it's measured at the time we levied it. So we put down $1 million. And it's available, which available means within 60 days of the year end for expenditures for year one. So available means it's available to spend in year one. So, and if it's within 60 days, we assume it's available to spend within year one. But we know there's some people, maybe some people have called up the city and said, hey, I can't pay you till March when I get my federal tax refund, or I won't have the cash till something happens. And can I pay you in March, or can I pay you in April? And we say, okay, well, we'll make arrangements for that. And so we know $80,000 isn't going to come to us till more than 60 days. Right, well then that's not available for year one. It's available for year two, but not year one. So we have to make a little adjusting entry to take that revenue off the books, because here we said we're going to get all $1 million available in year one, but we didn't. We didn't get 80 of it. So we're going to just take that off. So to take it out of revenues, we debit revenues. Isn't that weird? Debiting revenue? That's so weird to me. Debit revenues, and then we credit deferred inflows property taxes. So it's a little holding place. Yes, this will become revenues in year two, but for now it's just going to sit in this holding place called deferred inflows. Okay, so that's an interesting account that governments have. All right, so that's year one. During year one, this is what happened. We levied taxes, we collected taxes, and we did an adjusting entry for the taxes we're not going to get within 60 days of year end. Easy peasy. So what happens in year two with respect to year one taxes? Right, so we collected $800,000, right? We collected it and we took that out of receivables. It's now the asset cash instead of tax receivables. So within 60 days, so it's year one revenue, right? We got that, 120. But remember, we didn't take it out of revenues, so it's fine. We don't have to do anything to do with that. We got to put back on for year 2 those deferred inflows. So what happens is, and this is again weird, it's because it's a government, it wasn't available for year 1, but those 80,000 that we took off revenues back in year 1, that 80,000 just becomes year 2 revenue, because what makes revenue? Measurable and available for expenditure in that year. So this is available for expenditure in year 2. So it's year 2 revenue. So we put that on the books by going deferred inflows property taxes. So we reduce that account and we increase revenues by 80,000, but those are just year 2 revenues. And we collected some of last year's revenues and some of this year's revenues, 200,000, and that's just cash. When you collect stuff, it's cash, and it just becomes it increases cash, decreases taxes receivable. Now, what do they do for uncollectibles, right? Because sometimes you can't always collect everything people owe you. You try, and you can levy tax liens and all that, and especially if it's a sales tax and they've spent the money and you put a tax lien on and they just don't have any money, they have no assets, you can't get it. A lot of times you can, but sometimes you just can't get it. So what would have happened at the time of the levy, so back when we did this, right, if we estimated some uncollectible taxes, we set up an allowance, and then when we know who doesn't pay it, we write it off to that. Just very similar to allowance for doubtful accounts, right? So if you know there's going to be some you don't collect, if as a city or a school district, 1% or something, or 0.75% doesn't pay, 0.75 of 1% doesn't pay, you can write that off and set up an allowance, and then when you find out who it is, you write it off to the allowance. So to do that, they're due, you levied it, you go taxes receivable, 1,075,000, 75,000 goes to the allowance, that contra asset account, if you will, and then the $1 million goes to the revenue. So if your city uses, or your county, or whatever you are, school, you use the allowance method, you set that up front. Then when you find out who it is not going to pay their taxes, all right? So-and-so went out of business, they'd never paid their sales tax. Now the business is no longer in business, the person is gone, they're not going to pay it, bankrupt, whatever. All right, now you write it off, just like we always did. Allowance for uncollectible accounts, $5,200, taxes receivable, it's gone. It was never part of revenue, right? It was never part of revenue, so we don't have to take it out of revenue. All right, very good. Now let's look at expenditures. Now the thing to remember when you're doing expenditures on these governmental funds, the general and the special revenue funds, is that we've already set it up in the budget. All right, so we're not doing budget entries, right? But we are going to do encumbrance and then the expenditure. So remember, so we set up the budget accounts, which is always weird to me, right? That it's been appropriated. The city said this is how much money will be spent. And then you put it in the budget account, right? It's the budgetary fund balance. And then when somebody commits to funds being used, say they purchase something, they send out a purchase request and they know they've ordered these computers, they encumber those funds. Or I think the example I used was, I'm going to go on a trip for the university, so I put in that I'm going to spend $1,500 and those funds are now encumbered. I haven't gone on the trip, so they don't have the liability they owe me because I haven't done the trip yet. They don't really owe me the money till I make the trip. All right, so those funds are encumbered. All right, they budgeted whatever, $100,000 for faculty travel. I've encumbered 1,500 of it. And that's just keeping it from being overspent. Once it's encumbered, they can't spend it on something else. So they can't. So if all the faculty put in and nobody encumbered it, maybe they would end up spending too much. So if you put this encumbrance on, and then when the actual liability is incurred, when I take that trip, or when the computers purchased arrive, right? So now you have to pay for the computers. Now they have to pay me back for the money I spent on the trip. Now they take off the encumbrance and just pay for it, right? So that's how we do that. All right, so what would that look like? Well, so remember, it's already in the budget. So the budget transaction's been done. So now it's like we ordered computers, or I ordered a trip, you might say. So we ordered something, and so we would now debit encumbrances for that amount. So in this example, we're ordering something that cost $3,500. We encumbered $3,500. So that's debit encumbrances, credit the budget balance, right? So we've taken it out of that budget balance, so nobody can spend it because it's kind of out of the budget now. It's been removed. $3,500 lower in the budget. Budgets can't go negative. All right, and then at some point we receive the goods, or in my example, I take the trip for the university and do my research stuff. And so now the university or the city or the county, whatever, now they have the liability. They owe that. They have that account payable because the thing happened. The goods were delivered. The service was provided. They owe the money. So now we have the encumbrance turns into an expenditure, right? So we have expenditures is your debit and accounts payable, right? A liability. We owe that money now, so we have to recognize that liability. Accounts payable is a credit because that's how you increase liabilities. That's no different. Accounts payable is still a liability. We still increase it with credits. So expenditures and accounts payable. You also remove that encumbrance, right? You take that encumbrance off, and all it is a reversing entry of that, right? You take it out of the fund balance, and you take the encumbrance off. So it's just, you just reverse that, so that's gone, and then you pay it, right? And so you go accounts payable, so you reduce the liability, right? So that's always credit. And of course cash is an asset. I'm sorry, that's always a debit. When you pay a liability, that's always a debit. Cash is an asset, you decrease it with credits. So there's where you paid it. All right. Now, sometimes governments borrow. A lot of times governments borrow. What am I saying? They issue bonds. But in this case, we're going to talk about short-term borrowing. So, as we saw, not everybody pays their tax on time. So what the government will do to maintain their activities that they need to do is they'll borrow some money and use that to pay accounts payable and things like pay salaries and things like that. So they'll borrow some money, and they are expecting to pay off that money that they borrowed with the taxes that come in. So here's the accounts we use. So obviously we borrow money, cash comes in, right? Cash is still an asset. It's increasing with a debit. And we'll just call this account tax anticipation note payable. So see, there's that word payable. It's a liability. It's a liability we increased. So that's your credit. Cash, debit, got cash in, got a new liability, and of course when you pay it, right? Well, you got a note payable. You're going to have to pay some interest. People don't lend you money for free. And what do you pay for stuff with? You pay for stuff with cash. So in this case, the interest ended up being $37.50. So when we make that payment, we're getting rid of the liability, so you decrease liabilities with debits, so that note payable, $250. Interest expenditure, remember expenditures work like expenses, so they're debits. Interest expenditure, $37.50. And of course you pay for stuff with cash. When you pay out cash, you've decreased cash, so that's of course a credit. All right. So that's kind of how revenues and expenditures work. You know, now there could be separate accounts, right? You might have separate salary payable and salary expenditure and things like that, but in general, that's how those debits and credits work, right? I mean, obviously there's going to be some separate different accounts going on, but that's the general model, how you receive the revenues and how you pay for the expenditures. Next video, we'll talk about inter-fund transactions.